Good morning. It's a great pleasure to be here in Adelaide to be able to present to you about the global macroeconomy and how the Australian economy is travelling as well. I think it's fair to say that if you were to put me on the spectrum of economists, I'd probably be up the optimistic end. I've been optimistic about Australia for a little while now, and I think we are still doing quite well, particularly given when you ask an audience of people which way rates are going. They're all, the larger part of you are saying that rates are likely to stay steady. If you consider the global backdrop at the moment, you could argue that Australia is doing very well. Commodity prices are down 60% since their peaks in 2011. Global trade has been very weak since the global financial crisis arrived. And China's growth is slowing down. And if you were to take those three facts alone and try to work out what you thought would be happening in Australia, it's unlikely that that you would predict, with no other information, that the Australian economy would still be growing at 3% over the past year. So that is a little bit above its trend pace. A lot of this comes down to, in my view, the fact that the mining boom was very well managed by the central bank. The Reserve Bank of Australia kept very tight financial conditions when the mining boom was very strong. You remember commodity prices got to exceptionally high levels, record high levels, in 2011. We had the largest mining investment boom in the history of our country, and one that's very large by international standards, which peaked in 2012. Mining investment, which typically sits at about 1.5% of our GDP over the past century, got to a peak of 8% of GDP in 2012. So we had a massive positive shock in the form of rising commodity prices and a pickup in mining investment. Now, to manage that, the Reserve Bank of Australia lifted interest rates. You'll all recall, after the global financial crisis, they cut down to 3%, but then the economy started picking up, the mining boom revived, and they lifted the cash rate back up to 4.75% in 2011. Now, that was a high interest rate relative to the rest of the world. We had a cash rate at 4.75%. when the Federal Reserve, the US central bank, had already cut its cash rate, its policy rate to zero. It was already printing money. It was already doing quantitative easing. And so the high interest rates that we had here in Australia meant that the Aussie dollar also went to a very high level. You might recall back in May of 2011, the Aussie dollar got to 110 at one point in time. It averaged 105 against the US dollar through 2011 and 2012. And those tight financial conditions, that high interest rate and the high Aussie dollar, slowed down everything outside of the mining sector to make way for that mining expansion to happen without getting excessive inflation into the Australian economy. And if you look through the history of mining booms in Australia's, look through the past century of mining booms in Australia's history, every mining boom has been a mining boom followed by a mining bust. And so the RBA had to make sure that that didn't happen this time round. So what did they do? They had a high Aussie dollar and high interest rates, and it held back everything outside of mining. Tourism numbers were falling, international enrolments in our education facilities were falling, housing construction was declining, house prices were falling, the manufacturing industry was going backwards, and my job back then was to travel around the country and to travel around the world and talk to my clients and talk about the idea that Australia had a multi-speed economy. We had a two-speed economy. If you remember, the Treasurer of the day, Wayne Swan, spoke about the fact that we had a patchwork economy. I never quite understood what that meant. It felt like you were sort of knitting a quilt or something, but you got the gist. The gist was mining was going gangbusters and everything else was weak. But a lot of that was by design. A lot of it was the central bank wanting to hold back all those other sectors of the economy so that they could contain inflation through the largest mining investment boom in the history of our country. So that at the end, when commodity prices peaked in 2011, as they did, and mining investment peaked in 2012, as it did, the RBA could then cut interest rates, which they've done since then. They've cut from 4.75% now down to 2% on the cash rate. And that lower cash rate would encourage the Aussie dollar lower, and both the combination of lower interest rates and a lower Aussie dollar would then start to stimulate growth in all those other sectors of the economy that had been held back when the mining boom was strong. The RBA was afforded that luxury because they had held back all those sectors. Inflation was contained. They were able to cut interest rates at the end of that mining boom. So they cut interest rates, and the first thing that happened in the middle of 2012 is it started to show up in house prices. The first stage of this looser monetary policy in terms of lifting the economy was that house prices started to rise. Not everywhere, not in every city, and that makes a lot of sense too. It was mostly driven by Sydney and Melbourne. Sydney house prices picked up a lot, Melbourne house prices picked up a lot, and that makes sense because, of course, the mining sector was slowing down. Mining is obviously centred in Western Australia and in Queensland. It has some effect on South Australia as well, and growth was shifting. It was shifting towards housing construction, and it was eventually going to shift towards the services sectors. So we've seen house prices rise nationally by 30% over the past 4.5 years, since 2012, led by Sydney and Melbourne. Sydney house prices are up 47% over that period of time. Melbourne is up 35%, and the rest of the country is up about 10%. So house prices rose as a consequence of lower interest rates. The pickup in house prices then flowed through to a pickup in residential construction. Building approvals have been at their highest level in history in the middle of last year, and they've started to pull back a little bit now, but that high level of building approvals was a good story. We didn't build very many houses while we were building lots of mines when the mining boom was strong, because the RBA kept tight policy settings, so that when they loosened policy, we then had an undersupply of housing nationally. We needed to start building a lot more houses, and that's exactly what we've seen. Building approvals have picked up, they've been at record highs, and the housing construction cycle has been part of what growth has been rebalancing towards. It's been rebalancing from mining towards the housing sector. But of course, you can't keep building houses in perpetuity at very high levels. You'll end up with too many of them. And house prices can't continually rise faster than incomes either, because eventually you might end up with a housing bubble. We don't think that Australia has one of those yet. House prices are fairly high, but for some fundamental reasons, partly because we have limited supply. Supply is now catching up, and what you might be able to see already is that house price growth is starting to slow down in those major cities. In Sydney, house prices have now tracked broadly sideways since August of last year. In Melbourne, the growth has slowed down as well. And that's partly a reflection of the authorities wanting it to slow down by tightening up the prudential settings, but also a reflection of the fact that we've seen supply come online into those markets. So we had a housing boom that followed the mining boom. But what was going to come next? That was the key question, or that is the key question. What's going to drive our growth next? And what we've seen is that the lower currency, the Aussie dollar having fallen from 105 down to now sitting around just under 75 cents, is starting to see a pickup in the exchange rate sensitive industries. Tourism, education exports are now picking up quite strongly. This is being supported by a lower currency. It's given us a lot more competitiveness, but it's also being driven by rising middle class incomes in Asia. Chinese middle class incomes are rising, and the Chinese visitor arrival numbers have gone from 350,000 in 2010 to over 1 million visitors over the past year. We think those numbers have got a lot further to run, in part because only 4% of the Chinese population currently has a passport. And so there's a lot more expansion of those passport numbers to happen, and we think that's going to be a key support for growth. We've also seen this happen, a pickup in international enrolments in our education facilities. Australia is getting support from the fact that middle class incomes are rising, preferences are shifting, and a lot more people from Asia want to come and study here, and that's now, the enrolments have now hit a record high in 2015. So when I talk about the fact that Australia is doing quite well, and we're doing that despite the fact that commodity prices are falling, and we're seeing the biggest fall-off in mining investment we've seen in the history of our country, that's because we think growth, well, we've seen that growth is rebalancing. I think a lot of that rebalancing is because of the way the Reserve Bank has managed its financial condition settings, how it's managed its monetary policy. And so now the question, of course, and the one you've just been asked, is what happens next? What's the next driver of Australia's growth? Will those interest rates have to go up again at sometime soon, or is the next move going to be down? The challenge here is that it's not just a domestic story. Domestic growth is looking okay, as I've described. Growth is shifting from a mining-led story to a housing story that's now moving on to the services sectors. And I might add, that's also starting to create jobs. The unemployment rate has steadied over the past 2 years. It's sitting just over at around about 6% at the moment, having risen from 5% three years ago. When the mining boom came to its end, the labour market slowed down, but now we've made this transition. We're creating enough jobs to see the unemployment rate steady. The reason why the unemployment rate's steadying and we're creating these jobs is because even though the mining boom's over, the mining sector itself doesn't employ that many people. So growth is shifting from a source that's actually quite capital intensive, which is mining, towards the services sectors where it's a lot more labour intensive. It's a lot more people that are employed in the services sectors. In fact, if you do the arithmetic and you look at GDP, what you find is mining is only 10% of our economy. 90% of our economy is outside of mining. The services sectors make up over 70% of GDP. And that number looks even more stark when you think about it in employment terms. Mining only employs 2% of the total labour force. 98% of the jobs in Australia are outside of the mining sector, and over 80% of them are in the services sectors. So as growth has shifted from mining towards the services sectors, this has been creating jobs. The challenge for the RBA at the moment is not that growth isn't steady or that this transition isn't happening, because it is. It's that although growth, I've described a fairly smooth transition, and this growth story has been fairly positive, we're still left with growth overall that's a bit below trend. We're still left with an unemployment rate at the moment that's still sitting at 6%. Full employment in this country is closer to 5.25 or 5.5. So there's still spare capacity in the labour market. As we've seen jobs shift from the mining industry towards the services sectors, the wages tend to be lower in the services sectors as well. And so wages growth has been more sluggish. So wages growth has been more sluggish, and there's still spare capacity in the labour market. GDP growth is fairly solid, but it's not quite enough to generate enough jobs to get inflation to lift. And then you have to step back and look at what's going on in the rest of the world right now. As I said earlier, China's growth is slowing down. Commodity prices have come down. The world is still recovering from the global financial crisis. If you look at what's happening across the global economy, we have done quite well. We look quite impressive. But it is still the case that the developed world is still absorbing the effect of the global financial crisis. A simple metric to make that point. The US economy, having had a recession after the global financial crisis in 2008 and 2009, has been on a path to recovery. And the US economy is now 10% larger than it was back in 2008. That may sound reasonably impressive, but it's a pretty long period of time to have only grown by 10%. 8 years and it's only grown by 10%. Australia's economy, by comparison, has grown by 22% over that period of time. So we've had a much more impressive performance than the Americans. Unfortunately, the European economy is actually still slightly smaller than it was in 2008. The European economy had the global financial crisis and then the European financial crisis, and it's still not growing fast enough to have gotten back to even the same size that it was in the early part of 2008. So this is a big challenge. The developed world is still struggling to escape the effects of a large build-up in debt that occurred prior to the global financial crisis. And why have we been able to grow by 22% while the US has only grown by 10% and Europe is no larger? Well, I think the strongest story here is our ties to the Chinese economy. The Chinese economy is 85% larger than it was in the early part of 2008. We have benefited substantially, firstly, from a very large mining investment boom that was driven by Chinese demand for our iron ore and our coal, our liquefied natural gas and our base metals. And now we are in the process, as I've already described, of shifting the driver of our growth from mining towards the services sectors. We're getting support also from the Chinese economy because the Chinese economy is shifting its growth story from an investment-led story to a more services-driven economy as well. And that's seeing rising middle-class incomes, higher demand for tourism, higher demand for education services. This is a good story, this transition that's been going on. But we can't escape the fact that we're also tied to the rest of the world. The Federal Reserve has got its policy rate still at 25 basis points. It's extraordinarily low. The European Central Bank has cut its interest rate to negative 40 basis points. The Bank of Japan has just recently cut its interest rate to negative 10 basis points. Japan is struggling to get inflation. The Europeans are struggling to get inflation. In order to make that happen, they're cutting interest rates even further. They're printing money and they're cutting their interest rates to negative territory. So when you ask me this question as to what the RBA is going to do next, my view is not just looking at what's happening locally and looking at the fact that Australia's transition is working out quite well, our growth is quite solid, albeit not quite enough to generate a lot of domestic inflation. I'm also looking at the rest of the world and saying, well, interest rates are still extraordinarily low in the US. They're at 25 basis points at the short end. In Europe, they're at minus 40 basis points. And in Japan, they're at minus 10 basis points. And I'm also looking at the fact that these central banks are still not getting inflation to lift. Global inflation is very low. And with that challenge in mind, the real issue for the RBA is not so much that growth domestically isn't holding up, because it is. It's will they generate enough inflation to hit their inflation target? And their inflation in Australia has held up better than most. but we are at the bottom edge at the moment of the Reserve Bank's target band. Their underlying measures of inflation are sitting at 2%. Their target is 2 to 3%. And growth, as I say, is transitioning, but is there enough growth to generate a pickup in inflation locally? Well, the challenge is growth is still running a little bit below trend. It's hard to absorb such a big slowdown in the resources sector with a pickup in the other sectors. It's happening, but it's still not delivering as much growth perhaps as is enough to lift domestic inflation. And then the other challenge is a big driver of that rebalancing story that I've just told you about, shifting from mining to the services sectors, is about the currency having come down. The Aussie dollar has come down from 110 at its peak to getting to a low point of just under 70 cents. It's now sitting at just under 75 cents. That lower currency has been a key motivator of that rebalancing of growth away from mining towards the services sectors. If the currency starts to lift, and indeed over the past month or so, we've actually seen the Aussie dollar go from about 70 cents to now sitting a little under 75 cents. If the Aussie dollar starts to lift, then that's going to be a challenge for the RBA, because that may start to weigh on this rebalancing of growth. It may start to deter tourists from coming to Australia. It may slow down the education export story. It will almost certainly put a bit more downward pressure on inflation. So when I'm thinking about the answer to this question, I'm weighing up the domestic story, which says domestic conditions are quite good, the labour market's been improving, lower interest rates have been supporting that story, but I'm also looking across the world and saying, well, interest rates are very low in the rest of the world. They look set to stay low for quite some time, and that's what my global colleagues are all telling me as well. Inflation is very low in the rest of the world, and everyone else wants to have a lower currency. And of course, not everyone can have a lower currency. We don't trade yet with any of the other planets in the solar system. So if you have to have a lower currency, someone else has to have a stronger one, and no one seems to want a stronger currency at this point in time. So with that in mind, we actually think that on balance, the RBA may yet still have to deliver a further cut in interest rates, in large part because what they're trying to do is trying to get the Aussie dollar not to go up in a world where everyone else has got extraordinarily low interest rates. And that actually is one of the global investment themes that we've got in mind, and one of the things that you need to keep in mind in terms of the way you're thinking about your investment strategies as well. Our biggest global theme at the moment at HSBC is that inflation is low, and inflation will stay lower for longer. That is to say, there is excess capacity in global manufacturing, there's excess capacity in housing, in China in particular. The Europeans have significant excess capacity. Their unemployment rate is still at 10.4%, and full employment is more like an 8% level. And as I said to you earlier, the European economy is no larger, in fact slightly smaller than it was in 2008. With all that excess capacity in the world, and with also quite high debt levels in the Western world, we think that inflation will stay lower. And if inflation stays lower, it means that central banks are going to have to continue to run very loose monetary policy. As I've described, we've already got the Europeans cutting to minus 40 basis points, the Bank of Japan to minus 10 basis points, the Federal Reserve only at 25 basis points, and these central banks are all still printing money. What does that mean? Well, it means that bond markets, you're likely to see bond yields, particularly long bond yields, stay quite low. One of the boldest calls we've got at the moment is that the US 10-year bond, which is trading a little around about 2% at the moment, will be trading at 1.5% at the end of the year. We think actually inflation's going to stay lower for longer, and those bond yields are going to stay lower for longer as well as a consequence of that story. And of course, if central banks keep monetary policy loose, that's going to be somewhat supportive of equity markets. The challenge, of course, is with central banks pouring so much liquidity into the global financial system, you can have bouts of extreme volatility, which of course we've all just come through. When you came back to work after Christmas and had a look at what was going on in the market, certainly when I started doing this on the 4th of January, there was an extraordinary bout of volatility going on. We saw bear markets across the world. We saw equity markets sell off quite sharply across a range of different countries. And a lot of that has to do with this liquidity that's being poured into the system and pushing itself around the world. So with central banks likely to stay with very loose settings over the medium term, with interest rates likely to stay low, volatility I think will at some point in time return. That's one of the things that you can certainly keep in mind. So to wrap this up in terms of my view on what's happening for the Australian economy, I know there's already been a couple of questions here, so I might try and absorb those into my answer as well, into my summary as well. To wrap up, we do think that Australia is doing fairly well. We think, certainly considering that global backdrop of falling commodity prices, slowing growth in China, and weaker trade, we've done very well. But we think that still growth will remain below trend this year. And with below trend growth and an unemployment rate that's still sitting around 6%, we still think on balance the RBA may have to deliver a little bit more support for growth by cutting rates. We think that the main objective of that would be to try and make sure that the currency doesn't go up, because the currency at the moment is a key mechanism that's supporting growth in the economy. So that's our outlook for GDP. We think around about 2.6% growth this year. Our outlook for interest rates is that we think that the RBA may deliver one more cut around the middle of this year, although we don't think that there's a whole sequence yet to come. We're already at very low levels in the scheme of things. And for the Aussie dollar, although the Aussie dollar has gotten a bit of support recently, and we do think that that may maintain in the short run, we do think that 70 cents is probably closer to where we're headed in the medium term. We think fair value is probably actually closer to 65. It's just that the rest of the world at the moment has got such low interest rates and is pouring so much liquidity onto the global system that it is hard for the Aussie dollar to get back to its fair value. So I might stop there. I'll hand over to Stephen, and then I'm sure we'll be back for questions later.
Okay, thank you, Paul.
Good afternoon, everyone. Thanks very much, Paul. That was excellent. I'm in complete agreement with Paul in terms of domestic economic conditions and his sum up of the global economy. Essentially, I'd like to begin just by thanking Tom Garcia and AIST and the conference organisers for this wonderful opportunity to speak to you all today. My value add here, I think, will be to talk about longer term drivers, the longer term experience in the global economy, maybe from a more theoretical perspective. Just to begin, I'll sum this up for you. The potted summary is, we have, Paul described it great, Paul described this very succinctly, lower for longer. Where the global economy is now is in a low growth phase. It's in a low returns phase, and potentially in a condition of high volatility. My contention today is that it will stay this way, whilst we have policy frameworks that essentially promote short-termism, essentially are promoting a tilt towards financial assets and away from productive investment in physical assets, capital expenditure, greenfield construction, so on. So, this is a somewhat minority perspective in the economic community, but it has some good promoters, including some Australians as well, and I think it will bear fruit when thinking about it. Basically, we're locked into a low growth trajectory with current policy frameworks. So, to begin, I think as Paul has summarised, if you look at the large OECD economies, growth is currently now running at about 1.7 percentage points below the average experienced before the GFC. Excess capacity abounds in the global economy. We've got a China slowdown underway. The commodity slump is underway, and that's crimping incomes. And we have this phenomena, this longer term phenomena of low growth, low yields, and low capital expenditure. Now, what we are seeing is that policy is essentially contributing to uncertainty. And of course, uncertainty is anathema to strong, robust business investment. It's basically the situation that businesses are looking at the longer term horizon, are saying there are very low prospects for strong growth here. So we're going to sit on the sidelines until we see perhaps a more robust sort of policy environment, more responsible decision making by authorities, and potentially just stronger economic conditions overall. So that's the overarching environment that we've moved into. So how do economists explain this? They generally talk about productivity. They start with the productivity story, or they talk about population ageing, potentially high household indebtedness and high indebtedness of corporations before the GFC. These sorts of factors. Some might talk about savings imbalances caused by the strength of the Chinese economy, and certainly these are all factors which would contribute to sort of slowing trend growth rates in the global economy. However, put them all together and they don't really sum up to just the level of growth reduction that we seem to have experienced. There is an alternative perspective, and potentially it is contributing significantly to crimping growth outcomes and potentially adding to the short-termism that we're seeing on financial markets. And that perspective has it that we made a significant mistake back in the GFC. If you remember, policymakers essentially faced a dire choice. They could either, once they had reduced interest rates pretty much down to zero, they could either follow Lord Keynes's advice and essentially focus on a very targeted fiscal and structural policy reform agenda that essentially, through improving the mix of taxation in countries, in major economies, and potentially targeting infrastructure and high-valued public investment in various projects, could drive their economies back to full employment and hopefully do this over the short term. But that's not really what most chose to do. Through their central banks, we're talking now about the Federal Reserve, the UK, the European Central Bank and Japan, central banks took it upon themselves to apply a grand experiment to the global economy, and that was quantitative easing. And Paul's alluded to it earlier. Essentially what that involves is the creation of money, the expansion of central bank balance sheets, the purchase of long-dated securities, which drives up their price and drives down long-term yields. Now, this grand experiment was to work through the wealth creation transmission mechanism of monetary policy. Essentially, the idea was to rebalance financial and corporate balance sheets by driving up asset prices, allowing people to trade their way out of indebtedness, and potentially incentivising consumption and business investment through lower interest rates. Now, that policy has certainly been successful in terms of driving up asset prices. And I think, as Paul alluded to, in terms of real estate values in this country, what we've seen is the liquidity that was created on financial markets flowed through globally and essentially worked its way through property markets, bond markets, equity markets, to a point where Deutsche Bank had the global economy essentially at a sort of a 200-year high point for 15 rich economies by the end of last year. So mission accomplished if that was the objective of policy, driving up asset prices. Of course, if you're to look at the major economies and business investment in those economies, the story hasn't been as satisfactory. For example, for the United States economy, compared to the last high point before 2007, if you look at the yellow line in the chart that you're looking at now, this has been the shallowest recovery, certainly since John F. Kennedy was President of the United States. And the experience, as really Paul remarked, in Europe has been far worse. Business investment hasn't taken off. Nobody's buying this quantitative easing experiment, and the more authorities push against it, the more it seems to be rejected. And this is really unfortunate because if you look at corporate cash flows, there certainly is great capacity for greater investment. It's just that really picking up our earlier speaker from Ariel today, there are greater rewards now for short-termism. So what happens is corporate operating cash flows rise, firms don't invest for the long term, they send money back to shareholders in the form of buybacks or high dividends. And of course, firms that have pursued that objective have basically been rewarded for it. And that is the conclusion of Adrian Blundell-Wignall, an Australian former RBA official and of course OECD senior policy advisor. So this picture of short-termism doesn't seem to be going away anytime soon. So what do we do? What are the policy implications of all of this? Globally, to me, the macro policy canon needs to be reloaded. What that means is we need to rely more on structural policy and we need to address the idiosyncratic problems that that exist in various economies to drive more growth in the global economy. There needs to be higher returns for business investment and greater certainty for businesses to invest. We need to avoid snake oil solutions and adopt robust policy frameworks. And we certainly need to avoid politicians that would appeal to our baser instincts and look for those who want to lead us, maybe tell us what we don't want to hear. Governments also need to avoid trying to kick the can down the road. We are 8 or almost 9 years since the GFC and we ain't getting anywhere out of here anytime soon. As Paul said, lower for longer. We're stuck. International coordination is required, and as Paul said, you're not going to get that by beggaring your neighbours through exchange rate policies that seek to take advantage of others. Now, if we don't do these things, well, we're just stuck in this era of uncertainty, so that will persist. In terms of the Australian policy response, I just make the observation that there is significant structural reform that needs to be undertaken in this economy. We constantly get back to tax reform and improving the tax mix so it's more efficient and doing that in a fair way so that we're all better off because of it. I'd also make the observation that there are significant reforms that need to occur in the financial sector. And in terms of driving investment in infrastructure, I'd just ask you to consider the superannuation sector as a significant long-term investor, as a major player in this policy arena. Essentially, if you look, for example, at the pooled not-for-profit superannuation sector, it currently holds over $70 billion in property and infrastructure assets and is investing more every day in greenfield assets. So it has enormous capacity to shape the capital expenditure profile of the nation, and yet it has no seat at the table in terms of policy formulation. Essentially, it is dealt out of this story. So there is something there very obvious that could occur in policy terms that would help assist things dramatically. In terms of just finally, just thinking about what I've said in terms of investment strategy, I guess my advice would be to focus on the longer term, to focus on fundamentals, to see through the current market volatility. I mean, for example, the US market was down 15% to the end of the first week of February, and I think has recovered most of that subsequently. When I see volatility like that, I say get out of the market. That is a very difficult environment in which to trade. Focus on the longer term, focus on particularly, being a contrarian, take advantage of things that other people aren't looking at. For example, greenfield infrastructure. I very much thank you for your attention, and I'll hand back to Sam. Thank you very much.
Thank you. Thank you, Stephen. We do have some time for questions before we break for lunch. We've got some questions on the screen, but at the same time we'll take some questions from the audience. So if we have a microphone somewhere, there's a question, someone with their hand up here. But while we're doing that, can I just ask, take the prerogative to ask one question? Let me start with Paul. Paul, both you and Stephen affirmed what you said. Inflation will stay lower for longer. Many economists believe that you need inflation greater than about 5% in order to solve the global debt problems. First of all, do you agree with the magnitude of that number? And irrespective of whether you agree with it or not, where is inflation going to come from?
These are really good questions. On the inflation story, I mean, firstly you have to start with why we think inflation is going to stay low. The story here is we had a big build-up of debt in the lead-up to the global financial crisis. And in effect, when you build up debt, you borrow growth from the future. That's what you do. It turned out that some of that was misallocated, and so we haven't had as much growth more recently, and we can't ramp up those debts more substantially in order to support more demand. And so that's leaving us with low inflation. We have excess capacity. Now, if you want to work down those debts, that's the challenge. The challenge is trying to deleverage. One option is the one you've just described. Try to generate enough inflation to reduce the debts by inflating them away. And that is one option that is one thing that's what central banks have been trying to do. They've been trying to print enough money and cut interest rates to low enough levels to get businesses and households to do more spending, and for that demand to then create more inflation, and for that inflation to start working off those debts. The challenge is central banks have done that, but it hasn't generated enough inflation. We have a much bigger problem than that, a problem that just hasn't been solved by getting interest rates to zero. It hasn't been solved by the central banks going out and then printing money and trying to lower interest rates out the risk spectrum. That hasn't been enough. And what we're seeing as a result of that, I think, you can think of negative interest rates as just the next stage of that process. That is to say, you can deleverage, you can reduce those debt levels by inflating them away. Inflation goes up, that reduces the real value of those debts over time. Or what we're seeing is interest rates are falling to negative rates, and so in effect that reduces the value of debts. It does it more slowly, but it does reduce the value of debts. So you think about what you're doing. You're issuing a bond, and I might add that 1/3 of all European bonds issued up to 2015, at the end of 2015, were issued at a negative rate. They were issued at a negative rate. What you're effectively doing is issuing a bond where you will give you'll take a haircut at the end, right? In effect, you issue the bond, you give them a certain amount of money. When that bond comes for redemption at the end, it will be worth less than it was previously. That is a way of deleveraging, and that's exactly what's happening at the moment. We're not seeing inflation get rid of the debt problem. We're seeing instead moving into negative territory. And just to add a little bit to that, because there was a question that came up on the screen about how much further negative interest rates can go, really what I'm doing is saying, actually, it's quite possible that negative interest rates for central banks will become a bit more normal for a while, because we do have excess debts that need to be worked through. We don't seem to be able to generate enough inflation, and so one way this may happen is that interest rates stay negative, or maybe even go more into negative territory. This is an extraordinary world that we live in at the moment.
Okay, can I take the question from the audience?
Thank you. Paul, you talked about the transition to the services sector. Do you see that applying or sort of smeared equally right across the country, or do you see that some states have a bigger advantage than others? I would have thought New South Wales and Victoria had the advantage. And I'm from Queensland, so I have got a specific interest.
This rebalancing story we've been talking about is very geographically uneven. And in fact, if you look at the history of Australia's growth, growth is typically uneven. It's always multi-speed. It's always patchwork. It's always that one state's doing a lot, some states are doing a lot better than others. When the mining boom was strong, Western Australia was absolutely booming. This state was doing reasonably well. Queensland was booming as well. And New South Wales and Victoria were doing quite poorly. I mean, things were really held back by tight financial conditions. And now, well, the mining boom is over. Commodity prices are falling. Western Australia has fallen upon tougher times. So has Queensland. And growth is shifting back towards New South Wales and Victoria. Sydney and Melbourne are the centres of that, because as growth shifts towards being driven by the services sectors, by tourism and education, we're seeing that those sectors are the things that are lifting most strongly in Sydney and in Melbourne. So those two cities, I think, are benefiting the most from this rebalancing story. But you've got to keep in mind that Perth and Western Australia had a boom time for a decade. There was a long period where conditions were very strong in that state, and now they're starting to slow down. Now, I might add one more thing, and that would be to say that doesn't mean that there aren't opportunities in each of those other states. There are. It's just that when 38% of what you do, which is what is mining, which is what Western Australia is like, is slowing down, it's hard for the rest of the economy to lift enough to leave you with your economy having a high performance. But there are lower interest rates, the lower currency, the services story does apply to all of the states. It's just that some states are more exposed to that than others.
Okay, great. We'll take another question down the back there.
Hi, Con Mikalakis from Statewide Super. This is for Stephen Anthony. Two questions. One, it seems the half-life of a Prime Minister is 12 months and therefore no policy ever gets done. And then the second question is, I thought the cheapest cost of capital was government bond rates at 2.5%. Why aren't they doing any greenfield infrastructure?
Well, thanks very much for your question, Tom. Yeah, it does concern you, having spent all my life really in this country, that we have gone through this period of, 5 Prime Ministers in 5 years or something. It is very disappointing. It reminds us that maybe we're becoming Italy or something like that. And it certainly does feed into the narrative that politics is contributing to business uncertainty. I mean, go back to Wayne Swan's budget in 2011-12. This was the budget that included real GDP forecasts of 4% over the entire outlook, I think, and the budget returning to surplus within 2 or 3 years. So what would have been considered an incredibly optimistic scenario. Against that, Wayne Swan chose not to impose structural reform, undertake significant tax reform, opportunistically look to position Australia for a better future 10 years on. So there was no courage there from the sitting government, and we haven't seen a huge amount of courage, and certainly we haven't seen balance in terms of combining structural reform proposals with fairness since that time. So that's all very unfortunate. And certainly governments have felt constrained by their deficits and their structural budget positions from undertaking more greenfield investment and taking advantage of the low discount rates that they could enjoy. And also using the processes like Infrastructure Australia that identify a top 10 list of asset infrastructure projects that they could readily draw on to identify high-value targets for investment. The other issue is, why isn't the private sector investing more? And the RBA felt that, particularly in this country, businesses apply much too high discount rates to new projects, that maybe they should consider lower discount rates. But I say that's the wrong way of looking at things. That essentially, what we've done is we've made policy incentives the only game in town, particularly internationally. And until really policy gets out of the way, or at least addresses longer term footings and leaves business to make hard decisions about the future based on a more optimistic future, a more optimistic view of future, because policy settings are more constructive, then I think we stay where we are, and businesses, for the most part, stay out of or don't resume robust capital expenditures.
Okay, any other questions? I take another question. I'm not sure which of our guests to direct this to, so you can debate amongst yourselves as to who's going to answer it. But it's a question about the flow-on effects of China's recently announced intentions to grow its economy, and what the impact of that is likely to be on a commodity country like Australia, and in fact commodity countries around the world. But China recently announced that it intends to grow its way out of its debt problems, or out of its problems generally, and just acknowledging that only one country has ever done this in modern history, grow its way out of its debt problems, and that was the United States, and arguably it took World War II in order for that to happen, to underpin that growth. But the question is, can China succeed by going down the path of stimulating its economy, given in the context that it is a command economy?
You want to jump in? Yeah.
I'll just give you a few factoids and then hand to Paul. Essentially, that fiscal stimulus mostly will benefit Australia. Essentially, we have such a high exposure to the Chinese economy. 30% of our traded goods exports go to China. So if China can pull that off, we will be the major beneficiaries. Of course, the flip side of that is we will also be the major sufferer if the Chinese economy continues to slow and that stimulus isn't successful. I guess the other point that I would make is that debt levels in China have quadrupled since the GFC, so that the IMF now appears to view Chinese debt as a concern, and certainly credit ratings agencies have given them a negative rating or a negative outlook. So just some things to bear in mind.
Sure. Well, the Chinese economy does have some challenges. One of the challenges is they've built up a great deal of debt, which they use to invest in infrastructure and housing in particular. Some of that housing has been misallocated as well, and that presents them with the challenge they've got to manage. But there are a few differences between China and some other economies that have dealt with these problems. One key difference is that the Chinese economy isn't borrowing from anyone else. They have more saving than they have investment. They are net lenders to the rest of the world, and so they have what we call a current account surplus. They're exporting capital rather than importing capital, so they're not beholden to anyone else. Really, it's them working through their own debt challenges rather than the cash necessarily moving away from them. And so that does frame it slightly differently. The Chinese authorities, if they can work through the problems that they have, the allocation problem they have, they're not beholden to anyone else. I think the other factor that's important to keep in mind is China is still only a lower middle income country, and it's still got a significant amount of convergence yet to happen. There's still a lot of people who are working in the countryside. There's 500 million people who still live in the countryside who will gradually move towards the cities and become more productive. That's how the process of development happens. There's a lot more opportunity for convergence and continued growth rates that are faster than the sorts of growth rates that you would expect in a developed economy. And that faster growth should help to deal with, also absorb to some degree the debt challenge that they face. The Chinese authorities themselves are very well aware of the challenges they face, and they're seeking to try and shift their growth from an investment-led story, as it has been in recent years, to being more driven by the consumer. They want middle-class incomes to rise. They're seeking to get incomes to rise and for the consumer to be the next driver of growth. And what we're seeing in Australia is one of the tailwinds of that story, in the sense that our growth story has shifted from exporting resources and being for mining being the big driver of our growth, to being a more services-driven story. Tourism and education are the ones that we've talked about most prominently. And that shift in China's own growth from an investment-led story to a consumer-led story is something that will continue, I think, to benefit Australia. Not to say there won't be challenges and there won't be bumps along the way, but it's certainly a better situation that we are tied to the fastest growing large economy in the world at 6.5%, which is what the authorities are seeking to grow their economy by on average over the next 5 years. It significantly outpaces the US and Europe, which, as I said earlier, is no larger at the moment than it was 8 years ago.
Okay, I think a final question before we break for lunch. There was a question on the screen about geopolitical risks, and the person who asked the question simply asking the panel to comment on the geopolitical landscape and its implications. Could we have a quick 1.5 minute each kind of?
I think that this is always something which throws up the known unknown. You don't know exactly how the geopolitical risks are going to play out, but you can certainly point to all sorts of different tensions around the world, not least the current US political landscape. As you may have been watching your phones, Donald Trump looks as though he's solidifying his likelihood of being the Republican nominee, having won Florida, it seems. So, geopolitical risks can start from there. In the sense, watching the US election will be very important for working out what you think is going to happen in the US. You've got a lot of tensions rising in Europe at the moment, of course, with the migrant crisis, a significant number of people moving from the Middle East to Europe, and the Schengen Agreement being in question to some degree, the free movement of people across Europe. That's one of the challenges that Europe faces in absorbing that large number of people, but also the political backdrop of tensions because of those choices about allowing more migrants from the Middle East. You've got the ongoing tensions that are, of course, happening in the South China Sea, which I think obviously could have a large effect on us. But again, it's very hard to predict exactly what way it would go, or what it might actually lead to. And then you've always got ongoing tensions in the Middle East, which are having at the moment a big bearing on the oil price. Perhaps surprisingly, if you had thought about a year ago the sorts of developments you'd have in the Middle East, your prior would not have been to expect that the oil price would fall. It might have been that the oil price would rise. That's usually how we've thought about it in the past. But right now, the Saudis are pushing a great deal of oil supply onto the global market, somewhat as a geopolitical tactic, and that's pushing the oil price down rather than pushing it up. And it just demonstrates how difficult it is to quantify which direction some of these geopolitial risks might, the impact that these geopolitical risks might have on economic aggregates.
Thanks, Paul. I guess the observation I'd make is that if you look at measured trade, at least in terms of income at the moment, it is certainly in a very bad position globally, and what we like to see is shared prosperity, and at the current moment that's not what's sort of coming through trade statistics. And certainly the issues that Paul's raised in terms of the Middle East, really the aftermath of the Iraq War, in terms of the rise of ISIS and the problems in Syria, the problems with migration, and I guess the ongoing issues with North Korea and China and sabre rattling there. All of this feeds political uncertainty, and all of that feeds into a narrative of increasing volatility, increasing risk, and that is anathema for business making long-term decisions. It sort of feeds the short-term narrative, and that's not where we want to be. So I guess to the extent that cooperatively, internationally, we can solve some of these issues, that would be a good thing.